Last year, retail traders lost $42 billion in the forex market. That's not a typo. $42 billion gone, exposed, liquidated. But here's what's wild. The top 10% of traders didn't just survive that same market. They pulled consistent profits, month after month after month. Same charts, same candles, same news events, completely different results. Today, I'm going to break down the exact 5 mistakes that separate the 90% who lose everything from the 10% who build real wealth trading. And by the end of this video, you'll have the complete formula to switch sides. Let's get into it. Now, before we dive into the mistakes, I need you to understand something. The 90% failure rate isn't because trading is impossible. It's because most traders are playing a completely different game than they think they are. They think they're competing against the market, but they're actually competing against themselves. And that's a fight most people were never taught how to win. Therefore, every mistake I'm about to show you isn't a market problem. It's a decision problem, and decisions can be fixed, starting right now. Mistake number 1. And this is the one that has ended more trading careers than every other mistake combined. No risk management. Here's what used to happen to losing traders. They'd find a perfect setup. Gold is breaking out, everything lines up, the stars align. So they go all in. 10% of their account on a single trade, sometimes 20%. Sometimes, and I wish I was exaggerating, their entire balance. And the math is brutal. If you risk 10% per trade, you only need 10 consecutive losses to go to 0. Think that can't happen? Exposed. At a 50% win rate, the probability of 10 losses in a row over 1,000 trades is virtually guaranteed. It's not bad luck, it's mathematics. But here's what the 10% do differently. They risk between 0.5% and 2% per trade, maximum. No exceptions. No, this one's different. No, I feel really good about this setup. At 1% risk, those same 10 losses cost you $956. Your account is still alive. Your psychology is still intact. Your career continues. That's not conservative trading. That's professional trading. Therefore, before you ever look at another chart, you set your risk per trade. 1%. Write it down. Tattoo it on your forearm if you have to. This single decision will keep you in the game long enough for everything else to work. Mistake number 2. Strategy hopping. And this one is sneaky because it disguises itself as learning. Here's how the cycle worked for the 90%. They'd find a strategy on YouTube. Maybe it's ICT concepts. Maybe it's SMC. Maybe it's some indicator combo a guy with a rented Lambo showed them. They test it for 2 weeks. They hit a losing streak, 4, 5, 6 losses in a row. And then they think, this strategy doesn't work. So they switch. New strategy, new indicator, new guru, new Telegram signal group that costs $97 a month. And the cycle repeats. But here's the part nobody tells you. Every legitimate trading strategy goes through drawdown periods. Every single one. A strategy with a 60% win rate, which is excellent, will regularly produce 7 to 8 consecutive losses in a sample of 100 trades. That's not the strategy failing. That's statistics being statistics. Therefore, what the top 10% do is radically different. They pick one strategy, and they trade it for a minimum of 100 trades before they evaluate anything. Not 2 weeks. Not until it feels wrong. 100 documented trades with consistent execution. After 100 trades, the numbers tell the truth. Not your feelings, not your frustration after trade number 23, the numbers. And if the strategy has positive expectancy over 100 trades, you've found your edge. Now you refine it. You don't replace it. Mistake number 3, revenge trading. And this is where accounts go to die. Here's the scene. You just lost $50 on a clean setup, 1% risk, textbook execution. The trade just didn't work. That's fine. That's trading. But then something happens in your brain. A voice says, I need to make that back. So you take another trade, no setup, no plan, just emotion. You double your lot size because you want to recover faster. That trade loses too. Now you're down $150. The voice gets louder. You take a third trade, triple the lots. You're not trading anymore, you're gambling. And by the end of the session, that $50 planned loss has become a $600 account crater. 47 minutes. That's how fast revenge trading can destroy a week of careful, disciplined work. The 90% learn this lesson the hard way, over and over and over. But therefore, the 10% have a rule, and it's non-negotiable. 2 consecutive losses, you close the platform, not minimize it, not take a 5-minute break, close it. walk away, come back tomorrow. Because here's what tomorrow gives you that today can't: perspective. When you sleep on a loss, you wake up seeing the chart objectively again. The anger is gone. The need to make it back is gone. You're a trader again instead of a gambler. And that discipline gap, that single behavior, is worth more than any indicator, course, or signal group you will ever buy. Mistake number 4. And this is the one I said nobody talks about. No trading journal. Now, I already know what some of you are thinking. A journal? That's the big secret? Come on. And that reaction, that dismissal, is exactly why 90% of traders never improve. Here's what was happening to traders who didn't journal. They'd make the same mistake on Tuesday that they made on Monday, the same mistake on Friday that they made on Tuesday. They'd take the same bad setup in London session that burned them 3 times already that month, but they didn't know it because they had no data. They were trading blind. But therefore, traders who journal, even in the simplest format, start seeing patterns that are invisible to everyone else. They discover things like, I lose 73% of my trades taken after 3 p.m., or my win rate on GBP pairs is 38%, but my win rate on USD/JPY is 67%. Or every time I trade on a Friday, I give back my weekly profits. Those patterns are worth thousands of dollars, literally. One trader I know of discovered through his journal that he was losing an average of $237 per month on trades taken during news events. He stopped trading news. That single journal insight saved him $2,844 a year. The top 10% treat their journal like a scientist treats a lab notebook. Every trade is an experiment. Every loss is data. Every pattern is an edge waiting to be exploited. You will start journaling every trade the moment you decide you're serious about this. Mistake number 5, and this one is costing traders money even when they're making the right trades: the wrong broker. Let me show you the math that most traders never calculate. You're trading EUR/USD. Your broker charges a 2 pip spread. Doesn't sound like much, right? But you take 3 trades per day, 20 trading days per month. That's 60 trades. At 2 pips per trade on a standard lot, that's $20 per trade in spread costs. 60 trades times $20. You're paying $1,200 per month just in spreads. $14,400 per year. Now add overnight swap fees. Another $50 to $200 per month depending on your positions. Add slippage on entries and exits. Conservatively, another $300 per month. Commission fees if your broker charges those on top of spreads. The total? The average retail trader was paying between $18,000 and $24,000 per year in broker-related costs. That's money coming directly out of your profits. And most traders had no idea it was happening because they never did this calculation. Therefore, this is where the 10% get surgical. They choose brokers with 0 or near 0 spreads. They verify execution speed. They check withdrawal processes, because what's the point of profits you can't access? This is why I trade on Magno FX. 0 spreads on major pairs. 500 to 1 leverage, so I'm not tying up unnecessary capital. Same day withdrawals, my money when I want my money. And the Act Trader platform shows me my exact costs on every single trade before I execute. No hidden fees, no surprises, no $14,400 leaking out of my account. The link is in the description. But regardless of which broker you use, do the math. Calculate your annual trading costs. If that number shocks you, you now know what to do. Alright, you now know the 5 mistakes that the 90% were making. No risk management, strategy hopping, revenge trading, no journal, wrong broker. But knowing what not to do is only half the equation. Therefore, here's the complete formula that the top 10% use. And it's simpler than you think. Step 1, fixed risk protocol. You will risk exactly 1% per trade, not around 1%, not 1 to 3% depending on confidence. 1%. This is now a law of physics in your trading. Non-negotiable. Step 2, 1 strategy, 100 trades. You choose 1 strategy. You document 100 trades with that strategy. You evaluate based on data, not feelings. If the expectancy is positive, you keep refining. If it's negative after 100 trades, you pivot once and run another 100. Step 3, the 2-loss rule. 2 consecutive losses in a single session and you're done for the day. Close the platform. No exceptions, no one more. This single rule will prevent 80% of account blowups before they start. Step 4, journal everything. Every trade gets logged. Entry, exit, risk, emotion, grade. You review weekly, you look for patterns, you cut what bleeds, you double down on what works. The journal transforms you from a gambler into a data-driven operator. Step 5, optimize your costs. Calculate your annual broker fees. If you're paying paying more than $3,000 per year on a $10,000 account, you are feeding your broker instead of feeding your account. Switch to a transparent, low-cost broker that works for you instead of against you. That's the formula. 5 steps. No magic indicator, no secret algorithm, no guru selling enlightenment for $997. Just discipline, data, and a broker that doesn't rob you in your sleep. Now here's where you decide which side you're on. You can close this video and keep doing what the 90% do, or you can screenshot that formula, start your journal today, and take your first step into the 10%. If you want to start with the right broker, MagnoFX link is in the description. 0 spreads, same day withdrawals, 500 to 1 leverage. I'll also drop a free trading journal template down there so you have no excuse. Hit subscribe if you want more breakdowns like this. I drop a new video every week cutting through the noise and showing you what actually works in trading. I'll see you in the next one.